This is Mark to Market, a podcast of BT Correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters.
My fellow Americans, this is Liberation Day. Waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again.
We're in the month of May 2025, and I think it's fair to say that investors around the world have endured a very rough ride since US President Donald Trump's Liberation Day about 4 weeks ago. Right after he announced sweeping reciprocal tariffs on just about every nation around the world, the S&P 500 fell more than 12% in just 4 trading days, hitting a closing low of 4,982.77 on the 8th of April. The reaction in the US Treasury bond market was even more unnerving. While the 10-year yield initially slipped after the reciprocal tariffs were announced on the 2nd of April, it began rising shortly after, which was interpreted by many market watchers as an indication that US Treasury bonds might be losing their traditional safe haven status. Even worse, the US dollar was also weakening against other major currencies. It seemed at that point that there was a general flight of capital from the US. This sort of thing happens from time to time in emerging markets, but never in the US. And that's when President Trump blinked. On the 9th of April, he announced a 90-day pause on the very high individualized reciprocal tariffs for all countries. So, for instance, Japan was supposed to be hit with an individualized reciprocal tariff of 24%. Indonesia was supposed to be tariffed at 32% and Vietnam at 46%. Those individualized tariffs have been paused. Instead, all countries will be tariffed at a baseline rate of 10%. The exception is China, which has been slapped with repeated tariff hikes that now total 145%. Now, Trump administration officials initially said the pause was all part of the president's negotiating strategy and that it is an opportunity for America's trading partners to hammer out some kind of deal with the US. But Trump himself later admitted that he acted because investors, especially bond investors, were getting queasy. And that admission has injected some optimism into the markets. The fact that Trump pulled back from the brink seems to have convinced investors he isn't out to crash the US economy or trigger a massive dislocation in financial markets. In fact, 10-year US Treasury bond yields have since fallen below 4.2% from as much as 4.5% on the 11th of April. Meanwhile, the S&P 500 has also rebounded. It's been very volatile, but it closed at 5,525.21 just before this podcast recording, which was nearly 11% above its post-Liberation Day low and less than 3% below where it was before the reciprocal tariffs were unveiled. So, is this the moment to get back into the market? Or is it an opportunity to run for cover? I'll come back to these questions later in this podcast, but let me first try to unpack what Trump's tariffs mean for America and its trading partners. Even with the 90-day pause on individualized reciprocal tariffs, US consumers are now saddled with the highest average effective tariff rate since the early 1900s. And if it is allowed to continue, it's very likely that most of the world will suffer a slower pace of economic activity and reduced corporate profitability. For trade-dependent economies here in Asia, the tariffs would mean reduced exports to the US. In other words, there is likely to be a demand shock, which would have a deflationary impact on these economies. The immediate policy solution seems quite straightforward. Most countries will try to loosen their fiscal and monetary policy in order to cushion their economies and support employment. The impact of the tariffs on the US economy could be more complicated. There will be some demand shock as economic activity slows, but the tariffs will also create a supply shock as some importers stop bringing in goods because of increased costs. In fact, there was a very worrying story a couple of weeks ago about top executives at Walmart and Target warning the Trump administration that the import tariffs could soon translate to surging prices and empty shelves at their stores. Against this sort of stagflationary backdrop, the policy solution for the US is less clear. On the one hand, it would make sense to loosen monetary policy to boost economic activity. But on the other hand, the Fed may be concerned about acting too quickly and causing a surge in inflation. President Trump has been loudly urging the Fed to cut rates quickly to support the economy, and he's even publicly mused about removing Fed Chairman Jerome Powell before his term ends in 2026. This has obviously been unhelpful because it has raised questions about the Fed's continued independence. And even if the Fed eventually did begin cutting rates more aggressively, there would be this uncertainty in the market about whether it's acting only because of the president's threats. And this is where things could go badly wrong. Trump may end up causing far more damage to the global economy than he intends by eroding confidence in America's dependability. As I said earlier, Trump will probably not want to contend with the disgruntlement among American voters that would come from a big economic slump or market collapse, and that's why he went for the 90-day pause. In fact, not long after Liberation Day, the US authorities also clarified that several products, including smartphones, laptops, hard drives, computer processors, and memory chips, were actually exempted from the reciprocal tariffs. However, these products could eventually be subject to other duties. And of course, we've seen Trump recently soften his position on China, floating the idea of cutting the massive import tariffs his administration recently imposed and pledging to be very nice in any trade talks. So he's obviously looking for an off-ramp to avoid a major crash. But even if he succeeds in hammering out deals with all of America's trading partners, or eventually walks back the tariffs, the seeming capriciousness with which he's acted on its own might make businesses too nervous to invest and consumers too worried to spend. The same goes for threatening to fire the Fed chairman. Even if he doesn't actually do it, simply bringing it up is eroding trust in America's institutions, which is not going to be good for the economy or the markets. So what does all this mean for investors? Why is Trump trying to reset America's trade policy in such a radical and destructive manner? And what is he really trying to achieve? I'm going to talk about that next.
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to Market, a podcast of BT Correspondents.
One observation I made in a recent Mark-to-Market column is that US President Donald Trump's politics is about casting America as a victim and himself as its fearless savior, prepared to take action nobody else will in order to defeat its perceived enemies. On the matter of trade, Trump has long grumbled that America's persistent external deficits and loss of manufacturing jobs were the result of the rest of the world ripping it off. Now, this worldview actually has a kernel of truth. There is strong structural demand for the US dollar because other nations need to hold it to facilitate trade. And as the global economy grows and the volume of trade expands, demand for the greenback keeps growing. One outcome of this is that the dollar's strength makes US exporters less competitive, which creates a structural trade deficit. Or to look at it the other way around, America needs to keep supplying the world with dollars, which it does by running trade deficits. This is sometimes referred to as the Triffin dilemma, after the economist Robert Triffin, who predicted more than 60 years ago that this would happen. Here's how U.S. Treasury Scott Bessent framed it during a speech in March. He said, "The United States provides reserve assets, serves as a consumer of first and last resort, and absorbs excess supply in the face of insufficient demand in other countries' domestic models. This system is not sustainable." He went on to say, access to cheap goods is not the essence of the American dream. The American dream is rooted in the concept that any citizen can achieve prosperity, upward mobility, and economic security. For too long, the designers of multilateral trade deals have lost sight of this. But here's the thing. While Trump has identified a real problem that nobody has been able to solve, his reciprocal tariffs and the bullying and the grandstanding isn't the solution. In fact, Trump is just another problem on top of the problems that already exist. As I said earlier, Trump probably doesn't have the stomach for a big economic slump. So there is a high probability that the deals he's trying to negotiate with countries around the world won't be all that substantive. But at the same time, the nervousness and uncertainty he's creating could weaken economic and market confidence. Keep in mind, one reason the US has been able to run large and persistent trade deficits is that the rest of the world has been happy to channel their US dollar surpluses into the US capital market. And less of that flow of capital is coming directly from foreign official institutions like central banks. A lot of that capital flow is going through private sector financial institutions, whose primary purpose is generating good returns while avoiding risk. This is perhaps a big reason why US Treasury bond yields rose and the US dollar fell after Liberation Day. The fear was that the tariffs would spur inflation in the US, and the market began to demand higher risk premiums on US assets. Since Liberation Day, most markets around the world have taken a hit, and many of them have fallen more than the US market. But US stocks actually began falling from their highs in February, when Trump began imposing tariffs on Canada and Mexico, as well as China. If you zoom out a bit and look at year-to-date performance, it's striking how well some markets have done versus the US. Since the beginning of the year, the S&P 500 is down 8.5%, the Nasdaq 100 is down 7.5%, and the Russell 2000 is down 12.2%. But the Stoxx Europe 600 index is up nearly 3.1%, while the Hang Seng China Enterprises Index is up nearly 10.9%. One reason for this relatively stronger performance is expansionary policies in these markets. In particular, Europe is attracting a wave of international capital in anticipation of a big loosening of fiscal spending. Another factor is just that stock valuations are lower in these markets versus the US. Going by Bloomberg data, the Hang Seng China Enterprises Index is trading at just over 10 times earnings, while the Stoxx 600 is at 14.5 times earnings. The S&P 500 is trading at nearly 24 times earnings. And in case you're wondering, the Straits Times Index was up nearly 1% since the beginning of this year, and that's just a raw price change. On a total return basis, the relative performance of the STI versus the S&P 500 would have been even stronger because dividend yields are relatively high in Singapore. So, what should investors do? The advice we often hear from investment experts is that good returns come from time in the market, not from trying to time the market. So they often recommend some form of dollar cost averaging strategy, where you commit a certain amount of money to a portfolio of securities over time. And they will tell you to ensure that you maintain a broad portfolio and avoid being narrowly focused on a couple of hot sectors, and to ensure that you regularly rebalance your portfolio to avoid becoming overexposed or underexposed to certain sectors. This is all great advice, and from my own experience, money that is invested in the wake of a market correction tends to generate very high returns. But here's the thing. If you're on the wrong side of 50, as I am, and you don't have a very long time horizon, you might need to mitigate your risk either by reducing your exposure to the highest risk assets or having a good understanding of those risk assets. The way I see it, we are probably on the brink of sharply slower economic growth and weaker corporate earnings. So even though confidence seems to be improving, I'm not planning on wading further into equities for now. I'm more inclined to hold lots of cash and bonds and look out for opportunities. Over the longer term, the evolving relationship between the US and its key trading partners may continue to spur a shift away from US assets and create a host of new opportunities for other countries, especially in this part of the world, to restructure their economies and engage investors differently. For instance, as China gradually decouples from the US, it may continue to draw investors by flexing the progress its companies are making in new fields such as artificial intelligence, and by highlighting its efforts to adopt a more shareholder-focused approach to corporate governance. The markets in ASEAN, meanwhile, may gain new relevance after more than 2 decades in China's shadow. The key for companies in this region could be to demonstrate that they have a strong competitive advantage in their chosen field that goes beyond just low costs. And just to be clear, I'm not writing off US stocks, but I'm inclined to wait until valuations become much more attractive. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Quast, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Ben Paul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.